Do you know what Rocket Mortgage, Bank of America, Wells Fargo, Chase have in common in the United States of America banking industry? Yes, my friends, these are amongst the top 10 mortgage lenders in the US, running billion-dollar loan portfolios only on mortgages. Can you imagine the size of the asset portfolio? So, before they give out the loans, they have to do a very comprehensive process called as mortgage underwriting. Let's try and understand what is the meaning of underwriting in this video. This was a under over here, understanding mortgage underwriting. Oh my god. Let me not get into the tongue twister. If you're interested in a career in fund accounting, corporate actions, trade life cycle, and OTC derivatives, let me explain to you what we can get achieved in this specific industry. As you know, there are three types of underwriting in the finance industry. If you're an accountant or a finance expert, you will come across the term underwriting in the lending section. Okay? You will also come across the term underwriting in the insurance section. And if you're working in securities market and as an investment banker or a lead manager, again you'll come across the term underwriting. So let us now try and understand what is the meaning of these different types of underwriting in the context of financial services industry. The first one is loan underwriting. Every bank is in the business of lending, okay? And obviously that is the main source of income for the bank, right? The bank gives out loans, the bank earns interest income on that, and that is literally like the revenue for them, yeah? But in a bank, they have to follow a very systematic multi-step process before they agree to accept a borrower as an asset in the bank. We always tell KYC, 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 that means know your customer. But in bank, it is also KYB, know your borrower. Because you have to understand who the borrower is, what is his financial profile, what is his society profile, what is his economic profile before giving a loan to them, right? The last thing you want to do is take on a loan, sanction the money, and find out that the borrower is not in a position to pay you back. That will become a loss for the bank. The bank cannot incur losses on these kind of uh, relationships, and therefore banks have put together a very comprehensive multi-step integrated process called as underwriting while assessing and evaluating the credit worthiness of the potential borrower. What do we mean by credit worthiness? Credit worthiness means, is the borrower in a financial position to pay back the loan? This is a very important aspect because if the borrower is not good, then the bank can incur financial losses. Okay, and hence loan underwriting has become a very critical aspect of the banking industry. Now you find in India a lot of jobs, especially in investment banks, have been centralized. In underwriting function has been centralized because of the level of automation that has taken place in retail lending sector. Moving on, the second type of underwriting is in insurance. As you already know, insurance is basically a risk management product. If you have bought insurance for your warehouse and if the warehouse has burnt, yeah, reduced to ashes, then the insurance company will provide you compensation for that. That is the meaning of insurance. Therefore, should the insurance company give an insurance cover against fire for that warehouse? Pre-decision, pre-approval decision making is also taken in the case of insurance. This is known as insurance underwriting. The insurance company evaluates whether they should take on a specific insurance requirement or not. For example, there are 40,000 employees working in an IT company. Yeah, and the IT company approaches an insurance company for taking out a health insurance for them or taking out a life insurance for them. Then what are the process and parameters and justifications for the same? All that is considered in insurance underwriting. The third type, which most of us are very familiar, is the securities underwriting. In the securities market, there is an IPO, there is an FPO, there is an private placement of equity or bonds. The underwriter guarantees that if the subscription is not completed, then the underwriter will pick up the remaining unsubscribed portion. Therefore, the company that has issued the shares or the bonds is comforted that their issue has been fully subscribed to. This means, so what does this mean? This means that the insurance underwriting, loan underwriting, and security underwriting are all three different contexts, which you must understand in a different manner. We now take a look at what is a mortgage. A mortgage is a legal document against a home loan. Remember, when the bank is giving a home loan, who's using the house? The borrower is using the house. Yeah? The bank is not using the house. The bank's right to the house comes only if the borrower defaults. Therefore, in a mortgage, the bank has got nothing but this solid document to protect it, right, from potential borrower default. This is called as collateral. A collateral is a comfort given to the bank that their loan is in, that their asset is protected. In case the asset goes faulty, then they'll be able to sell off the collateral and recover the money. Home loans are secured loans which have very long term maturities, and the repayment is typically on a monthly installment basis. Let's analyze each of this. A bank gives out loans which can be secured loans or unsecured loans. Which of this is more risky for the bank? Do you think it is secured loans or unsecured loans? Obviously, your answer is going to be unsecured loans is more risky. But a bank does not see that every time an asset goes bad, they're going to sell off the collateral. Yeah? So then you will say that, anyway, I'm giving collateral. Suppose a drug dealer comes to the bank and says, I want a home loan of $10 million. Yeah? The bank will say, okay, where is collateral? They'll ask first. No, they'll first ask, what is your profession? Yeah? Before asking whether what is the collateral, they'll ask what is your profession? Only then they can give the loan. Therefore, in a bank, secured loans are more comforting, that's all. Yeah? But it does not eliminate the risk of default. It minimizes or reduces the risk to a small extent, but does not eliminate it. Second one. In secured loans, there is a collateral provided. This collateral is called as lien in the case of gold, pledge in the case of other items, mortgage in the case of homes, hypothecation in the case of vehicles, etc. In home loans, the collateral is the underlying house. Therefore, the most important credit decision to be taken over here after evaluation of the borrower is LTV ratio. Okay, this is not a type of television set, yeah, not OLED TV or any other kind of television set. LTV stands for loan to value ratio. Unfortunately, home loans also have very long term maturities, 10 years, 15 years, 20 years. And any time in that period, 10 years, 15 years, 20 years, the asset quality can turn bad. Yeah, you could be having a great career to start off with, and you've taken a home loan of like $1 million, and then economic recession hit, and after 8 years, you're not able to pay the EMIs back. So therefore, the asset quality can deteriorate anytime in this very long maturity that is there. This puts the bank in a very, very risky position. Not only does the bank have to give out loans so that it can earn income, it must also ensure that the loans that it gives out are of good quality. Otherwise, everybody will become like a Vijay Mallya. This risk that is faced by the banks is called as credit risk. The risk that the borrower is no longer able to service the loan. The borrower is unable to pay the timely EMI. This credit risk is the biggest risk in the asset portfolio of a bank. Underwriting process hopes to minimize the credit risk. There is a pre-approval process wherein before approving the borrower, the asset for which the borrowing is taking place is approved. There is an assessment of the borrower's credit worthiness. And does the bank lend in this particular sector? All these three come into picture and form a nice little movie when there is an underwriting process in place. The entities that are involved typically would be bank, obviously. Sometimes even credit unions are involved in the financial transaction, and mortgage brokers. So first, mortgage application is filled in by the applicant, by the potential borrower. Underwriting comes out with a response that whether it has to be approved or declined. So, what is this big underwriting? Underwriting. I've been going on saying. Let's take a look at that. The steps involved in underwriting are collecting information about the borrower, analyzing this data, and verification of the data. There are four C's that are involved in underwriting. Typical marketing, the typical management jargon. The first C is capacity, the second C is collateral, and the third C is credit. Fourth C, suspense story. I'll keep it for some more time. Okay? Capacity. The first C, capacity. Does the borrower have the capacity to repay the loan? Okay, he's taken the loan. She has taken the loan. What is her income levels? Does she have the ability to pay back the loan? Is she earning more income than the monthly repayment? Correct? All this become very important to decide. For this, employment history analysis is done. I'm a freelancer. I will not get the same amount of loan that you all might get because you're a full-time employees working at a hedge fund or at a mortgage underwriter, right? So the analysis of the employment of the borrower is done. This analysis reveals two very important things. What is the nature of monthly income? First of all, is she earning monthly income? For example, film stars. Yeah. If the movie sells very well and they get a lot of money, they get crores of rupees, but they don't get it as monthly income. They get it as one-time income. Sometimes the movie flops and the film star has lost money also in it. Yeah. Because he's wasted his time in making a flop movie, in acting in a flop movie. Then then his cash flows begin to suffer. But of course, film stars have so much of money that they don't actually take loans, right? They're not going to take loans from the industry. But just to give an example as to how cash flows, if they're comfortably, monthly, it's more comforting for the bank. And then you have to know what is the present debt that is outstanding. What are the outstanding loans that the bank has all that other banks also have provided to the borrower who has applied for the loan. The next one is collateral. What is the asset that is being financed? Is it a disputed property? Is it a property that comes out of the wildlife reserves, protected property, etc.? Therefore, in this context, we'll have to understand what is the loan to value. Is it a loan to value ratio? Is it a property whose prices are going on fluctuating? Yeah, therefore, we have to understand what is the LTV ratio or the loan to value ratio. Normally, the loan to value ratio will be lesser than 1. Lesser than 1 implies that which will be higher? Collateral value will be more, loan value should be less. That buffer should be there. To give the lender some comfort, there's a buffer between the loan amount and the collateral value. Okay? But if the real estate market crashes, then the loan to value ratio could become more than 1. How can it become more than 1? Because the denominator, collateral value, has collapsed. The loan amount has increased, has remained the same. The loan to value ratio becomes greater than 1. This means that the bank will be in distress because even if the borrower does not pay and the bank manages to seize the asset and sell off the asset, they will not be able to get that kind of money. Then the third concept, if borrower misses the payments, the loan amount will increase because there will be penalty charges, late fees, etc. Bank will face recovery problems. So all these things come into picture in the LTV ratio. The third one is credit. What is the credit history of the borrower? We get this from the credit reports as well as the credit score. Many banks are comfortable with only giving a good entity can be very rich, okay, but can have a poor credit score. So a credit score is not a function of how much wealth they have, but about how much they can raise. This reveals the existing loans and previous credit history and also talks about is the borrower having any intention to pay or not. This brings into picture the DTI ratio or the debt to income ratio. Generally speaking, this should be below 50%. High DTI ratio is a red flag for the bank. The borrower is already having too much of debt and the bank is giving further debt. That means the borrower is taking a new loan just to pay off an old loan. So all these things come into picture in the case of analyzing the credit history of the mortgage applicant. I mentioned only three. Did I forget something? But I said four C's. Yes, my friend, the fourth C over here is common sense. Use your common sense before you can give out a loan. Everything will fall into place if you use your head and analyze the evaluation of the borrower. Thank you so much for listening into this video. Share the contents, subscribe to my channel and like this video.